Everyone's asking which metal is the better buy right now, gold or silver? That's the wrong question. It's a debate that gets clicks, but it misses the real driver. In the last couple videos, we built the framework and then walked through the silver plumbing. Now we're tackling the debate without getting trapped by it. The real story, the one that will actually impact your wealth, isn't about gold versus silver. It's about how a series of historic policy mistakes by the world's central banks is setting the stage for an explosive move in both metals. Figuring out why one is now a critical safe bet, while the other offers aggressive, life-changing growth, that's the only thing that matters. For years, they've sold you a simple but misleading story. When interest rates go up, gold goes down. It sounds logical, but it's a dangerous oversimplification designed to keep you watching the headlines. The key is to watch the plumbing, not the headlines. The truth is, nominal rates are noise. The signals that matter are negative real interest rates and the liquidity that follows. When real rates go negative, metals stop acting like commodities and start acting like money. The real interest rate is a simple calculation. The interest rate the bank pays you minus the actual rate of inflation. When that number turns negative, your wealth is being systematically destroyed. This isn't just an economic data point. It's a flashing red light signaling that monetary policy is failing. And right now, that light is blinding. Central banks are trapped. They know that if they raise rates high enough to genuinely fight the inflation their policies created, they will bankrupt governments and crash the entire economy. So they're forced to choose: sacrifice the economy or sacrifice the currency. History shows they always choose to sacrifice the currency. This is the heart of the issue, and it is the most powerful argument for owning hard assets. It's why gold's price action hinges less on interest rate announcements themselves and more on the policy mistakes they signal. Here's the thing about central banks. They don't just react to crises. Their policies create the conditions for them. Gold and silver's reaction follows a predictable sequence, a clear what happens first, then next scenario. Act 1 is driven by fear. As a crisis builds and policy mistakes become clear, gold leads the way. Act 2 is driven by stimulus. When the central banks inevitably panic and flood the system with liquidity, silver provides the torque, delivering explosive, leveraged returns. We have seen this playbook run over and over. Remember the 2008 global financial crisis? The Fed held rates too high for too long, popping the housing bubble. This was the fear stage, Act 1. Gold saw it coming, exploding from around $700 to over $1,900 an ounce. Then came Act 2, the stimulus. Facing a total collapse, they panicked and flooded the world with quantitative easing. Silver, the more volatile metal, went on an absolute tear, surging over 400% to nearly $50 an ounce, and delivering outsized returns for those who saw the setup. Then came 2020. The sequence played out again. In response to the global shutdown, gold once again led the charge in Act 1, hitting a new all-time high above $2,000 as it hedged against the coming currency devaluation. And just like before, when central banks opened the monetary fire hoses wider than ever, silver followed in Act 2, rocketing up over 80% in a few short months. Many of these crises follow a similar script. A policy mistake leads to a predictable panic, which ignites an explosive rally in precious metals. Now, here in late 2025, and we must speak in probabilities, not certainties, the stage is set for the biggest policy challenge yet. Government debt is at levels never before seen in history. Inflation, while cooler, is still stubbornly high. The central banks have run out of road. This puts them in a position where currency devaluation is a highly probable outcome, and the price action in both gold and silver reflects this growing risk. So, in a world with rising risks of policy failure and currency destruction, how do you position yourself? You don't listen to the bankers who created the mess. You watch what they do, not what they say. You turn to the enduring safety of hard assets. And this is where the conversation changes. It's not gold versus silver anymore. It's gold and silver. with each playing a vital, distinct role in your financial survival. Gold is the confidence hedge. Silver is the torque. The ratio tells you which regime you're in. Gold is considered the ultimate safe haven asset for one simple reason. It is the only major financial asset that isn't someone else's liability. For 5,000 years, it's been a bedrock of monetary systems, a stable store of value that has outlasted every empire and every paper currency. In this financial storm, gold is your cargo ship, slow, steady, and built to weather any tsunami the central banks can throw at it. If you need proof, just look at the central banks themselves. Over the last few years, they have been buying gold at a historic, record-breaking pace. Why? Because they are quietly hedging against the failure of the very system they're in charge of. They are building their own lifeboats while telling everyone else the ship is unsinkable. This move signals a fundamental repricing based on a global loss of faith in government-managed money, which explains why gold has already shattered its old records, pushing past $4,500 an ounce. For a portfolio, gold serves as that essential 5 to 10% core hedge. It's your insurance policy against systemic chaos. It's your foundation. If gold is the steady cargo ship, silver is the sleek, powerful jet ski riding in its wake. It's often called gold on steroids, and for good reason. Because its market is so much smaller, any new wave of investment capital sends its price moving with incredible speed and force. That's why, while gold has been setting records, silver has had an incredible run in 2025, surging well over 100% and more than doubling in price. But silver's real power comes from its dual identity. It is both a monetary metal and an indispensable industrial commodity. More than half of all silver gets consumed by industry, in solar panels, electric vehicles, and virtually every electronic device you own. This industrial demand isn't optional. It's growing relentlessly, driven by the global green energy transition. The world needs more silver, but for 5 years straight, we've been in a structural supply deficit, meaning we use more than we produce. This creates a powerful dynamic. So let's check our dashboard. The metrics we watch are always the same: real yields, liquidity from the Fed's balance sheet, inventory trends on the LBMA and COMEX, lease rates, and of course, the gold to silver ratio. Today, even after silver's huge run, the ratio sits in the low 60s, while the historic average is in the 60 to 75 range. The data suggests that as this monetary situation unfolds, the ratio will compress further, meaning silver will outperform gold. Projections from major banks show a move toward the $50 to $65 range is plausible, with some outliers calling for much higher prices. This is not a safe bet, it's an aggressive growth play. Silver is the 2 to 5% satellite position in your portfolio, designed for leveraged, outsized returns. If you're starting to see that the real game isn't about picking one metal over the other, but about understanding the system that's driving them both, then make sure you subscribe and hit that notification bell. We break down these central bank moves every week, so you can stay ahead of what's coming. So, is silver a better hard asset than gold right now? It's still the wrong question. The right question is, are you prepared for the policy mistakes that are already in motion? Stop getting lost in the gold versus silver debate. That's the distraction. Remember to watch the plumbing, not the headlines. The real story is the ongoing devaluation of our currency at the hands of central planners. Your strategy should be built on this reality. You use gold as your bedrock, your Act 1 defense against the systemic instability that is a growing probability. It is your wealth preservation tool. Then you add silver as your Act 2 play for aggressive growth, a leveraged bet on the inevitable policy response and an industrial revolution that literally cannot happen without it. Gold is the confidence hedge. Silver is the torque. The ratio tells you which regime you're in. This isn't about picking a side. It's about understanding the framework and the signals so you can build a strategy to protect yourself and position your wealth for what comes next. In the next video, we'll connect this dashboard to positioning. What changes if we enter a confidence regime versus a liquidity regime, and how that affects gold, silver, and Bitcoin differently.